the Japanese candlestick chart. Get to know the main chart patterns. You probably think that financial analysis is complicated, but it actually comes down to two simple things: reading charts and reading news. There are many types of charts, but Japanese candlestick, or simply candlestick, are the most popular ones. Such a chart consists of red and green candlesticks, or candles, lined one after another. Each candle gives you detailed information about the price movement within a specified time interval. In fact, Japanese candlesticks are the best way to visualize the ups and downs of a price so that you can spot potential opportunities to buy or sell. Let's take a more detailed look. Every candle consists of a body and one or two tails called shadows sticking out of it. The body indicates the range between the open and close price for a specific time frame, and the shadows represent the highest and lowest price levels reached for the set interval. Japanese candlestick charts are easy to read. A red candle shows that the price is going down, and a green one represents an increasing price. If you're looking at a 10-minute chart, each candle represents a 10-minute time interval. We see a green candle when the open price is lower than the close price. If the price closes lower than it opened, then the candle is red. As simple as that. What kind of signals does a candlestick chart provide? It's no surprise that candlestick charts are so popular. They're excellent for spotting market turning points. By looking at the patterns that candles create, you can often guess if a certain market is about to continue in its current direction or reverse it. Patterns that show that the market could change direction are called reversal patterns. They could be bearish, ones that indicate the change from an uptrend to a downtrend that should be perceived as a signal to sell. Or bullish, these show that a price that has been decreasing is likely to start going up and we should buy. Let's see the most popular candlestick patterns which encourage you to buy. Bullish engulfing. The bullish engulfing consists of a red candle followed by a bigger green one, which fully engulfs the red candle. The pattern is an indication for a market turning point. In simple words, it's likely that the market may start going up and you can buy. The indication is even stronger if the green candlestick engulfs 2 or 3 red candles. Hammer. The name of this candle is pretty much self-explanatory. You'll recognize the hammer by its short body, lower shadow that is about 2 or 3 times the length of the body, and a shorter upper shadow, or no shadow at all. The hammer is usually a clear indication of a declining price reversing its direction and starting to go up, so you can start buying. But just to be safe, you could always wait for additional confirmation. Such confirmation is a green candle closing above the open of the hammer, for example. Morning doji star. This pattern appears when there is a slight market movement and consists of 3 candles, a red one, followed by a doji, followed by a green candle closing beyond the middle of the first candle. If the green candle is longer than the red one, the signal is even more reliable. Spotting the morning doji star is a signal to buy. Some chart patterns that mean you can sell. Bearish engulfing. This pattern is the opposite of bullish engulfing. A green candle is completely engulfed by a following red candle. When you spot it, you can sell, as the sellers on the market have possibly managed to overpower the buyers and the price direction could reverse. Dark cloud cover. The dark cloud cover appears before the price drops down. A long green candle is followed by a red one that opens at a new high and closes below the middle of the green candle. Keep in mind that when trading currencies, a second candle opening at a new high is rare, so the red candle usually opens at the close level of the green one. Once you see this pattern, you can go ahead and sell, or you can wait for another, smaller red candle to form and confirm the dark cloud cover. Shooting star. The shooting star is a red candlestick with a small body, long upper shadow and a short lower one. When it appears at the end of an uptrend, it shows you that you can sell, since the price, which has been rising up to that point, may start falling instead. See? Reading Japanese candlestick charts is not rocket science. Just make sure to observe your charts carefully and you'll soon learn to spot patterns as they form.
In this tutorial, you will learn what trend reversals are, what benefits trading trend reversals provides, where to place your stop to limit potential losses, and where to take profit when trading trend reversals. What is a trend reversal? A trend reversal is when the market changes direction and starts to move in the opposite direction. An uptrend, which is identified as a series of higher highs and higher lows, reverses into a downward trend by changing into a series of lower highs and lower lows. By extension, a downward trend, which is identified as a series of lower highs and lower lows, reverses into an uptrend by changing to a series of higher highs and higher lows. Reversals can occur at any point and are generally difficult to anticipate, but trading reversals can provide an opportunity to profit from a new trend. If the timing is right, you will essentially be able to profit from the entire new movement and make significant gains. Looking out for reversal patterns can also be beneficial, as they can indicate the need for a different trading strategy. For instance, if you notice a reversal pattern and you have a long position, you may consider closing it to go short to profit from a new downward movement. The pin bar. The pin bar formation is one of the most common price action reversal patterns. The pin bar has a short body and a long wick, essentially showing that for all the trading activity, the price ends up very close to where it started. So from this candle we can see that the price went to a certain level and then came all the way back near the opening price. Trading pin bars is convenient as you can easily identify them on the charts. They show that the current trend has most likely run its course and is ready to reverse. These are the characteristics of a well-formed pin bar. The wick must be much longer than the body. The wick must also be much longer than the previous bars and stick out from the rest. The body is at one end of the wick, so not in the middle. The price has to close within the previous candle's high or low. To effectively trade pin bars, it is not enough to make sure that it is well formed and has the characteristics we just described. To reduce the number of losing trades with pin bars, trade with additional confirmation such as support and resistance levels, trend lines, and moving averages. To illustrate how support and resistance levels can provide additional indication that a trend is about to reverse, let's take the following example. In this chart, we see that the price of the instrument is in a strong downward trend. A pin candle forms, but we are not sure whether the price will reverse from here. But if we take into account support and resistance levels, it shows us a clearer picture of what the price might do. We see that the pin forms around the zone of support. Therefore, we can consider it as a strong signal that a reversal might form because we now have two indications, the pin bar formation and that it formed at the support zone. Once you have a valid pin bar setup, you are ready to prepare your entry. We will discuss 3 ways to enter the market when trading pin bars. All 3 have merit and will depend largely on your trading style and market conditions. To illustrate the entries, we will consider a bullish pin bar. Here you see a pin bar with all the characteristics we just mentioned. The first entry is at the close of this bar. The advantages of this entry is that you are sure to be filled and be in the trade. The second is at the break of the nose. To enter at the break of the nose, you would set a buy stop order just above the high of the wick. The idea here is that if the price went up from this close, then you would be filled and in a good position to take advantage of the price upward momentum. The advantage of this entry is that you can avoid some losing trades. Sometimes the price will fall from the close and plummet until you're stopped out. The trade-off with this entry is that while it can save you from some losing trades, it also means that if it turns out to be a winning trade, this position would put you at a slight disadvantage as the distance between the tip of the nose and the close can be significant and would negatively affect your risk-reward ratio. The third entry is waiting for a retracement. This is the ideal entry but also the hardest to achieve. If you've watched our previous video on retracements, you'll know the basis of how trading retracements work. You would set a pending buy limit order at the 50% retracement level. The ideal situation here would be that the price would come down to the retracement level and then shoot up from there, giving you an impressive risk-to-reward ratio. Of course, a very frustrating circumstance would be if the price shot up from the tip of the nose or from the open, leaving your limit order unfilled, missing the trade. Now that you have your entry in place, you need to decide where to place your stop loss. Basically, you should place your stop loss just above or below the pin bar tail. So for the bullish pin bar in our previous example, we would set a stop loss just below the pin bar tail. Where to take profit? If you're new to the trading pin bar setup, we suggest setting your take profit at the first area of support or resistance. When you have some experience with trading pin bars, you could try using a trailing stop. When trading reversals, you don't know exactly how long the momentum of the new trend will last. For this reason, using a trailing stop would allow you to gain the maximum profit from the momentum while having your stop in place when the market turns. In this way, you would hold your position until the trend exhausts and reverses once again. Alternatively, you can also choose to exit portions of your trade to secure profit along the way. Let's go to the platform to demonstrate how to trade the pin bar setup. We have opened the chart for the Australian and US dollar in a candlestick mode at a 1-hour time interval. The pin bar is easily recognizable and has the necessary characteristics. To add confirmation that this is a valid pin bar setup, we check to see that it formed in an area of resistance, as the price previously tested the level here. With this added confirmation, we are now ready to enter our trade. Things to watch out for. Timing is essential in this strategy. If you enter too early or too late, you may miss most of the benefit this strategy provides. However, trading absolute tops and bottoms is extremely difficult and results in bad trades and frustration. A more reasonable approach is not to look at it as a small window of time when you can make the best trade, but rather look for something that qualifies as a good moment. Trends usually last longer than other formations and, if identified correctly, can outweigh any small miss in the timing. Thank you for watching this tutorial on trading reversals. We will go over how to trade retracements. Once again, keep in mind that each strategy will take time and practice to master. We suggest you take advantage of the free practice account in the Trading 212 Pro platform to test the strategy with live prices. In this tutorial, you will learn what retracements are, what benefits trading retracements provide, what Fibonacci retracement levels are, and finally, what Fibonacci extension levels are and how you can use them as take profit levels. What is a retracement? Retracements are short-term price corrections during an overall larger upward or downward movement. These price corrections are temporary price reversals and do not indicate a change in the direction of the larger trend. Finding and trading retracements is a method of technical analysis used for short-term trades. The main benefit of trading retracements is that they provide an opportunity to profit by entering a trade in the original direction of the trend at a better price, just before the continuation of the move. Why do retracements occur? I will illustrate with an example, assuming we are talking about a large upward trend. A significant number of traders start to buy as they believe the market price will increase. This pushes the market higher, and as more traders notice the movement, they start buying as well. When the movement has gained traction, some traders will close their position to take profit, and this may result in a temporary sell-off, and the market will pull back and the upward momentum will be suspended. After this, the original forces that formed the trend resume their activity, and the price continues to rise until the trend has run its course and reverses. So how would you enter your trade in a retracement? What's first? The first thing you need to do is find a strong upward or downward movement of a given financial instrument. To find a good entry position, you should look to enter the market in the direction of the trend right after a pullback has occurred. Put simply, you should buy pullbacks in an uptrend and sell rallies in a downtrend. However, how do we know when the market will pull back? This is where Fibonacci retracements come in. In order to apply Fibonacci retracement levels to your chart, you need to identify the swing high and the swing low points of a trend. A swing high is identified as the highest point displayed on a given time period. A swing low is created when a low is lower than any other point over a given time period. Using the Fibonacci retracement tool in the trading platform, you draw a line between the swing low and the swing high. The horizontal lines that occur are the Fibonacci retracement levels, which are automatically calculated by the trading platform. The most popular Fibonacci retracement levels are the 38.2%, 50% and 61.8%. In the Trading 212 Pro platform, you have a Fibonacci retracement tool. It places support and resistance levels on your chart based on the Fibonacci numbers. There are many theories, mathematical equations, and strategies out there that try to make sense of a market that is largely speculative. However, it is widely accepted among traders that rely on technical analysis that most major moves will retrace around the Fibonacci levels, and more specifically around the 50% level of the move. So in an uptrend, a price will retrace down a certain percentage of the move before continuing its long upward movement. Likewise, in a downward trend, the price will move up a certain percentage before continuing its long-term downward movement. If the price moves beyond the 50% level, it might be a signal a trend reversal is about to happen, and it may be an opportune moment for switching the direction of your next trade. In this tutorial, we will simply refer to the Fibonacci retracement tool and how to use it. We will be explaining the mathematics and more on Fibonacci in following video tutorials. So traders use these Fibonacci levels as efficient entries in the direction of the trend because many traders watch these same levels and place buy, sell, or stop orders based on them. They are quite accurate and become a self-fulfilling prophecy. So how should you enter in an uptrend? You can use the Fibonacci retracement levels for an entry into the market. For an entry in an uptrend, you should look to see whether the price finds support at these levels. Then we suggest you wait for confirmation that the price will move back into the original upward movement and then enter. As with any technical indicator, it is better to seek additional indications to support your initial analysis so that you don't base your trade solely on Fibonacci retracements. Look for clear signals to buy or sell. For instance, wait for a candlestick to close in the desired direction to give you more confirmation on whether you should place an order. If it does form, you can place a market order at this point as you have solid reasons to believe that this level could hold. How to enter in a downtrend. Likewise, for a downward trend, you can place your entry after the price has found resistance at one of the Fibonacci levels. After you wait for confirmation that the price will move back into the original downward trend, you can place your entry order. So how to place your exit? Now that you have decided on your entry, you need to determine your exit strategy. Your exit strategy is comprised of two steps. First one is deciding where to place your stop loss, and the second is where to place your target profit. Let's look at the same graph that we had for our upward trend. Here we suggest you place your stop loss just below the retracement level. In a downward trend, we suggest you place your stop loss just above the retracement level. Where should you take profit? And now for the best part, your target profit. If we use Fibonacci retracement levels to forecast entries into the market, we can use Fibonacci extensions as reasonable profit targets. Fibonacci extensions make good potential take-profit levels for trades in the direction of the trend. Similar to the retracement levels, the key Fibonacci extension levels are 38.2%, 50%, 61.8%, as well as 100%, 138.2% and 161.8% extension levels. The Fibonacci extensions correspond to retracement levels, making it all very simple. If you enter at 50 or 61.8%, a good take profit is the corresponding extension level at 161.8%. Let's go to the Trading 212 Pro platform to demonstrate how to use the Fibonacci retracement tool. Here we have opened the chart for the German index DAX in a candlestick mode at a 1-hour time interval. The price's movement is easily recognizable. In the Trading 212 platform, on the side you have a Fibonacci icon. When you click it, you choose retracements. Then you click right where the trend begins and drag until you reach the end of the movement. Where the move started, you'll see a 100 displayed on the side, and where it ends, a 0. When you have plotted this line, the Fibonacci tool automatically places the retracement levels based on the Fibonacci number sequence. In our case here, you see a retracement at 38.2% and we would enter at this level. We would then place our stop below the entry level. You could place it either below the 50% or the 61.8% level. We will take the first Fibonacci extension level at 61.8% as a reasonable target profit. To summarize, a retracement is a short-term price correction during an overall long-term upward or downward trend. The benefit to trading retracements is that they provide an opportunity to profit by entering a trade in the original direction of the trend at a better price. The basis of the trading strategy is to buy pullbacks in an uptrend and sell rallies in a downtrend. A good way of identifying them is to use Fibonacci retracements. To set your take profit, you can use the Fibonacci extensions as reasonable profit targets. As always, we recommend you use stop losses. They can be placed above or below the last retracement level. What to watch out for? Each strategy has its risks. When trading retracements, make sure that it is a temporary reversal and not a new move in the opposite direction. This would essentially be a reversal, not a retracement, and would incur a loss for the trader who's placing orders with the original move. Strategies we will discuss. In this first tutorial, we will go over how to trade breakouts. Keep in mind that each strategy will take time and practice to master, so ease into the material and take advantage of the free practice account in the Trading 212 Pro platform to test certain live scenarios. So what is a breakout? A breakout occurs when the price breaks out and closes above a resistance level or below a support level. Let's quickly have a look at a candlestick chart to illustrate what support and resistance levels are. A support line can be identified by connecting the low points of an instrument's price. They are identified as low points if the price rebounded upwards right after reaching them. By definition, the support line needs at least 2 points to be formed, but we suggest finding 3 points for a stronger indicator. The support line can be horizontal or angled. Resistance lines are effectively the same as support lines, with the marked difference that they are above the current price and act as a ceiling from which the price falls from. Again, they can be horizontal or angled. When we have a support and resistance line together, they create a trading range, so both lines keep the movement of the price within a certain range until the price makes a break, either above or below. Trading ranges are formed due to supply and demand and market psychology. When the price breaks out of the range, it signals a change in the supply and demand and the beginning of an upward or downward trend. Let's say the price breaks out above the resistance level. At this moment, the resistance line might become a new support level as the supply and demand has shifted, so most likely new levels of support and resistance will be established. So here's the general concept to trading breakouts. You can use the breakout strategy to trade forex, stocks or commodities, and it works with any time frame. It's a method of technical analysis that follows certain rules and can be applied universally. So what's first? First, you need to find a financial instrument, a currency pair, stock or commodity with a clearly defined support or resistance level. We only need one clearly defined support or resistance level to anticipate a breakout. However, a trading range created by both a support and resistance level is more beneficial as you can take advantage of the breakout in either direction, so either above or below the current range. That said, how should you enter your order in a breakout? We will assume that you expect the breakout to be above the current range. So there are several ways to enter the market at a breakout, all depending on your trading style and risk tolerance. The first is at the actual breakout. To trade at the breakout, you would need to devote more time to actually watching the market so that you can place a market order whenever the breakout occurs. This is the most risky entry point as the movement has not been confirmed and there's a high chance that the price will move back into the trading range. The second entry type is a pending order at a price level placed above the current range. This is a preset price level that can be based on the current range or determined by an indicator. We recommend that the price level of the pending order is at a previously unachieved high. It does not require you to watch the market as the order will be executed automatically upon reaching the price. The third entry is to wait for the candle on the time frame you've selected to close above the range, reaching a new high and in this way confirming the breakout. We suggest that you exercise patience in order to confirm the breakout. Having the candle close above the range is one of the strongest possible signals for a continued upward movement. Once you have determined your entry, you'll need to have your exit strategy in place. A good way to determine a reasonable target profit is to analyze the previous price movements of the financial instrument. Your exit strategy will largely depend on the specific trading circumstances, trading style, your expectations, and the risk-to-reward ratio you're using. The balance you have to consider when placing your stops to exit your trade is to set them not too far so that you don't lose too much money if the market turns against you, and not too close so that small price fluctuations take you out of your trade too early. In this case, we could decide to place it right about here, which would be at our maximum permissible loss. One thing to look out for when trading breakouts is fake breakouts. Fake breakouts occur when the price breaks past the support or resistance level, but instead of continuing its movement, the price moves back into the previous trading range. So here we can see that the price breaks outside of the range but does not close above it. Instead, it returns back into the trading range and does not continue its movement upwards. So if you had placed your entry here, you would in fact have been caught in a fake breakout. In order to decrease your chance of trading a fake breakout, we suggest you wait to see if the price will continue to move in the intended direction. For instance, it's good to wait for a new high before going long. In this way, you will sacrifice some of the momentum of the trend, but you will ensure it's going in the direction you anticipate. Let's go to the Trading 212 Pro platform to illustrate a real live example of trading a breakout. Here we have the US dollar Japanese yen chart in candlestick mode at a one-day time interval. Each candlestick represents the trading activity of one day. The first thing you needed to do is to have a clearly defined trading range. You can of course just have a support or resistance level, but we are going to go with the trading range as it's more beneficial. We see here well-defined tops, here and here, creating a resistance level, and clearly defined bottoms, here and here, that create a definite support level. Here we can see that the market has tested the highs and lows quite a few times, and we can be fairly certain the market won't hold this for much longer, and so you can expect a breakout. It may be tempting to enter the market when it's volatile and moving fast like over here, but this may lead to rushed decisions that won't result in the desired outcome. So a better strategy is to position yourself so that you're trading stocks, commodities or currency pairs that are currently low in volatility like we have here, and place your order so that it is ready to ride the trend whenever the breakout occurs. So you would need to place your entry order just above the high or just below the low so that your order is automatically entered when the price moves. To see more information on this, you can refer to our video on entry orders. Thank you for watching this tutorial on trading breakouts.